Did you know that you can legally make money tax-free by investing in real estate? And you don't have to leave the US to do that. If you're new to the channel, I'm Arianne and I retired with investment income at the age of 27, and I made this channel to help good people like you learn how to build wealth and create financial freedom. In this video, we're going to cover how you can make money tax-free by investing in real estate, and we're going to go over the two ways to do that. There's the basic way, which is the straight line method, and the more advanced way, which is the accelerated depreciation method. Now, as a disclaimer, I am not a CPA, so you will want to consult yours. So the US tax code has certain things they want to incentivize people to do, and they give people tax benefits to do that. One of those ways is by owning real estate and renting it out so other people can have housing. This tax benefit is called depreciation. The IRS basically says that real estate houses or buildings that are rented out for residential purposes, so people live there as their home, those properties can be depreciated over 27 and a half years. So they allow us to take a tax deduction for this. So let's use a hypothetical example to illustrate this. Let's say Susie buys a house for $300,000, right? So Susie buys a house. Now, when you buy a house, usually it's on land, right? So we gotta figure out what the land value is. And let's just say that $25,000 is the value of the land. So what's remaining is $275,000, and that's just the house, right? So the IRS lets you depreciate the house, not the land. So that's why it was important for us to write down the land value. So now we're working with this $275,000, which is what Susie can depreciate over 27 and a half years. So that's something that the IRS just came up with, essentially. They're saying that a house typically lasts 27 and a half years. So you can write off what the house is worth, right? So the 275K over 27 and a half years. So that equals $10,000. So this 10K a year is the depreciation that Susie can write off from her taxes each year. So pretty cool, right? Susie bought a house and now she gets this tax benefit. So now to illustrate the point a little more, remember how earlier we said that Susie bought the house for 300K, right? So Susie bought the house for 300K. She put 20% down. So that's 60K. And then she also had closing costs and she needed to paint a little bit and improve the property. So all in, her all-in investment into this rental property is $70,000, right? Now, after all the expenses and mortgage payments are paid from the rent, right? So she collects rent, she pays all of the expenses, the property taxes, insurance, mortgage, property management fees, and all that. Her net cash flow is $7,000. Now that's pretty good. That's a 10% return on her money. That's a pretty good return. 10% in cash flow, right? But wait, remember, Susie had that $10,000 deduction each year from just owning this real estate. So Susie actually makes $7,000 cash. She gets 7K cash in her pocket each year, but she has a $10,000 deduction. So when she files her tax return, she actually ends up with a 3K loss, right? 7,000 positive. This is positive 7K minus 10K. So that equals a negative $3,000 loss on her tax return. So even though Susie makes $7,000 a year on this investment, she gets to write off $10,000 a year off her taxes. And when you do the math, right, she looks like she lost $3,000 that year, even though she actually made this $7,000 right here, right? She collected $7,000 in the bank. But on paper, she lost $3,000. Now that is how you make money tax free, right? The 7,000 Susie made that year is tax free until she decides to sell the property, which we'll cover in another video. But as for that year, if she doesn't sell the property, she made that income tax free. Plus, Susie can even write off an extra $3,000, right? Because she has this extra $3,000 loss. She can use that to offset any other passive income gains she has from other assets or other businesses. So that's the basic way depreciation works. And this is called the straight line depreciation method. So just that is pretty amazing, right? Like you could stack up enough rental income so you're making a lot of cash flow each year to replace all of your income. And guess what? You are paying no taxes on that income, which is pretty amazing. And if you have even some extra other income, you can use the extra losses from those real estate depreciation to offset some other passive gains. Now, some people use a more advanced method of depreciation. They use what's called bonus depreciation and or accelerated depreciation. So we will cover that here. So in the earlier example, remember how we could depreciate 1/27.5 per year? Right? So it's whatever your property is worth minus land over 27.5. Well, in the bonus depreciation method, you can usually depreciate around 20 to 30% of the total value of the asset all in year one. So that is pretty amazing, right? So 20 to 30% depreciation in year one. That's why it's called accelerated depreciation. You can accelerate it. And you can do this by doing an engineer study that you pay for called a cost segregation study. So for Susie's 300K house, for example, right? Remember, the house was 300K, well, when she bought it, but the actual property value is 275K, right? So this is after you take out the land value. Now, let's say she does the study, the cost segregation study, and she ends up getting it back, and it says that the depreciation she got was around 25% of 275K, which equals around $70,000, right? So let's round that to that number. So in year one, Susie can depreciate $70,000. Now it could be more or less, but that's just, let's say that's what she got. So she has an extra $70,000 in deduction that year. She can use that as a deduction against her other passive income. Let's say that Susie happens to be a doctor that is part of a partner group that covers several hospitals. Susie makes $300,000 as her salary as a doctor, and then because it's a business, she also gets another $250,000 as passive income from that partnership business that is reported on a K-1 tax form. Now, because she has $250,000 in passive income, she can use this $70,000 deduction to offset part of her passive income for that year. Because remember, she only made $7,000 in the actual rental property cash flow, so she has a lot of extra. And if she applied this $70,000 deduction, then at this 37% tax bracket, that would equal $25,900 in tax savings, right? Which is amazing. She saved an extra $25,900 just from investing in real estate. Plus, she's also still getting that cash flow from that real estate investment. Plus, it's also still growing and appreciating. Plus, the tenant is paying down the mortgage, so her net worth is growing. On top of getting this 25,900 tax free, which is amazing, right? So Susie is super happy because she now can use this extra 25,900 in taxes she saved to keep on reinvesting in more assets to increase her cash flow. And she can do anything with that. She doesn't necessarily have to reinvest it. She could go on vacation with that money, right? It's just extra money that otherwise she would have just paid in taxes. And now she doesn't have to because she invested in real estate. And now she's actually thinking about investing in more real estate to offset that entire $250,000 in passive income that she gets from her partnership group. She's also looking into syndications and funds because that's a more passive way for her to invest in real estate. And we have a playlist about syndications and funds. I'll put it up here and then I'll also put it in the link below so you can check out more videos to see how you can truly invest passively in real estate. And another thing I want to mention, there's another tax designation that allows you to use these deductions from real estate to offset not just passive income, but also active income. I'll talk about that more in another video, so make sure you click that subscribe button so you see my new videos as I upload them weekly. And hopefully you saw the power of real estate investing and how you can legally earn money tax-free by investing in real estate. If you want more research to learn more about real estate investing and wealth strategies, we also have a free Facebook group called Faster Financial Freedom, where you can learn more about real estate investing, passive income, and growing wealth. I'll put a link to that down below. We also have an application-only program called Wealth Accelerator for people who want to retire with investment income in 1 to 3 years and want one-on-one coaching for that. So go to wealthgym.com to learn more about that. I'll post a link below as well. Well, thank you so much for hanging out with me, guys. You have an amazing day, and I will see you at the next video.